So again, welcome to the Brody's Banking and Finance Academy webinar on sustainable finance and the importance of ESG for banks. Your speakers today are myself, Katy Preister, my colleagues Claire Devlin and Hannah Sinclair. And today we're going to be talking about ESG principles, how to utilise your loan documentation to implement ESG principles in practice, and also discuss some of the challenges for lenders when it comes to ESG and sustainable finance. So moving on, as the world increasingly focuses its attention on ESG matters, ESG has crept up the boardroom agenda of companies and lenders and is now firmly in the spotlight on financing transactions. You might be thinking, why now for ESG? Why is it everyone talking about it now? Financing the transition to a net zero economy was one of the key topics of discussion at COP26 in Glasgow last month. And it's quite clear that in the private sector, lenders have a key role to play in helping companies to realign their business models for achieving net zero. It's also clear that there's a global focus on these issues and it's not a trend that might be disappearing. Companies and consumers alike are also increasingly looking beyond climate change. They're also considering wider environmental issues such as nature, biodiversity, inclusion, the living wage, fair taxation, supply chains. And there's also a growing attention on the need for a just transition, which considers the social consequences of the shift to a net zero economy. So actors across the spectrum of financial services can be a force for good in this area. Institutions, both large and small, can use their business decisions, their innovation and creativity, and their voice and influence to encourage positive change. But with that, there is a risk of harm if the financial sector responds to rising consumer demand and awareness of ESG issues without adequate safeguards being in place. Consumers and the media are increasingly questioning the integrity of some of the green claims made by companies and financial firms, with some being accused of greenwashing. The UN recently released guidelines for climate target setting for banks, which make it clear that banks need to adjust their business models in the short and long term to develop realistic strategies in order to achieve the Paris Agreement objectives. So banks can support the transition to a net zero economy through their lending and their financing decisions, but also through facilitating their customers' transitions. So complying with the guidelines fits in with bigger picture ESG obligations for the wider good, but it's also being increasingly accepted that ESG is at the heart of it, a risk matter for banks. The risk comes from several angles. There's the reputational and financial impact of ESG issues being handled insufficiently, and consumers wielding their collective power to drive greater sustainable corporate practices, as well as the risk of not attracting or retaining employees if they feel that their ESG values are not reflected in the bank's own. So what do we mean by ESG and why is it important? Well, ESG and sustainability are terms you probably see and read about every day. Terms such as climate, environment, sustainable and ESG are often used quite loosely across the financial sector and sometimes interchangeably, which can cause a bit of confusion. If we could just move along to the next slide, sorry. There's also a bit of overlap between the terms that people use. So climate change is a core focus of the environmental work, which is of course the E in ESG, but it's important to bear in mind that the social and governance aspects of ESG as well. And ESG is about the wider sustainability, which is how people, planet, prosperity and purpose come together to enable the needs of the present to be met without compromising the ability of future generations to meet their needs. So what do we mean by ESG? Well, there are the three pillars of performance by which a business's impact on society and its effect on environmental sustainability can be evaluated. So by understanding a company's strategy and performance in each area, key stakeholders such as investors, employees, consumers and governments can decide how they want to interact with that company. So the environment component covers how the company interacts with the natural environment, things like the impacts of its operations and the actions that it takes to mitigate negative effects. When companies are evaluating their environmental footprint, they must account for their entire value chain. So that would be direct emissions, raw material use, land use, water consumption, waste creation, but also quite importantly, the indirect effects that occur upstream or downstream from the business, such as carbon emissions from the products used by consumers. The social component of ESG covers how a company's activities affect the people, so from its own workforce to customers, local communities, and those who work in its extended supply chain. The social element covers a broad range of factors, including fair pay and safe working conditions, workforce health and well-being, diversity and inclusion, equality, and guarding against modern slavery and child labour. The quality of a company's relationships with its stakeholders can significantly impact on the organisation's performance and stability. So it's well known that good employee relationships tend to lead to a more productive workforce, whereas poor relationships might give rise to industrial action and pay disputes. The governance component of ESG relates to the policies, structures, and procedures by which a company is run. So that explores the decision-making processes, distribution of rights and responsibilities between elements of the organisation, including the board and senior executives. Things that come under this component might include monitoring board composition and skills, gender pay gap, executive pay, oversight and scrutiny, and reporting transparency and accountability. So these definitions of factors tell us what they are, and they're issues at a very high level, but it's when we view the ESG through different lenses by stakeholders such as investors, businesses, and consumers, we can get a better understanding of why it matters. So we just click on to the next slide. For investors, ESG will allow them to screen potential investments beyond purely financial metrics. This isn't a particularly new idea. Socially responsible investors have been excluding certain companies or industries from their portfolios if they were involved in ethically or socially undesirable activities or regimes. So for example, the apartheid in South Africa or the tobacco industry. But ESG has gained traction in recent years as investors have realised a company's ability to respond to issues such as climate change and large-scale societal shifts is a pretty good indicator of its potential to deliver good long-term returns. For businesses, ESG is both a risk and an opportunity. Investor and consumer scrutiny mean that ESG failures can be a significant risk to the future prosperity of a business. Strong ESG performances can increase trust in a business and can make it easier for a business to expand. Operationally, a business will need to have a detailed picture of its performance on crucial ESG metrics and its progress against these metrics that has to be monitored and reported on to give stakeholders data on which to assess the business. It's this focus on data and measurability that is what sets today's ESG apart from previous corporate social responsibility initiatives. So getting access to the right data and ingesting it into systems for analysis and ESG reporting is one of the key operational challenges for lenders and businesses alike. And Hannah's going to talk a bit more about this later. And for consumers, while they might not use the term ESG to explain how they view a business, instead they might talk about their reputation on environmental issues or on workers' rights. But this is all part of ESG, and social awareness of ESG is increasing. The pandemic in particular has shone a light on global inequality, and at the same time, large climate events such as wildfires and floods and social issues such as racial injustice have risen in profile, and increasingly consumers are becoming more aware and want to know what businesses are doing in response to climate and social issues. Many also want to understand what they can do themselves to reduce their impact on the planet. So for consumers, viewing ESG conscious corporations helps them to align their actions with their values and make decisions across a broad spectrum of issues. So from things like what companies to buy from or to choosing who they're going to be working for. Brewdog, the Scottish brewing company, is a recent example of when ESG can go wrong. You might recall back in June, Brewdog came under fire when a number of former employees published a letter claiming that they were bullied and that the executive leadership fostered a culture of fear. Almost immediately off the back of this, Brewdog appointed a new chairperson to their board, who also happened to be a senior executive of one of their largest investors. So this kind of high-profile criticism can remain at the forefront of the minds of consumers and investors for a long time, particularly for a business like Brewdog, which uses its culture and ethos as a marketing tool, and it will remain to be seen whether this will have a financial impact on their business going forward. Moving along, now that we know why ESG is important, how is it actually implemented? Claire's going to talk a bit more in detail about how to implement ESG in loan documents and how to set measurable and impactful ESG targets. But first, I'm just going to touch briefly on the two most common categories of ESG loans that we see in the marketplace, which are green loans and sustainability-linked loans. So green loans have developed out of the long-established green bond market, and essentially those are loans that are to be applied for the sole purpose of a specific environmental project or impact. So examples might be the funding for the development of a wind farm, or funding for the development of a housing development that meets passive house standards. Sustainability-linked loans, on the other hand, are loans which contain a feature whereby the performance of the borrower is measured against certain external ESG metrics, with that performance triggering certain outcomes, normally an adjustment to the margin. The volume of green loans has grown quite steadily, but the product's inherently constrained by the availability of a suitable green product. Sustainability-linked loans, on the other hand, can be applied to a wide range of transactions and as such have grown in popularity in recent years. The use of a pricing mechanism linked to an external set of metrics is quite an easy feature to incorporate into a loan agreement, and there's no need for it to be part of an underlying environmental financing, so it can be made available to almost any borrower. It's also equally suitable to be included in a revolving loan as it would be in a term loan. Support for both the green loans and sustainability-linked loans is provided by the Green Loan Principles and Sustainability-Linked Loan Principles published by the LMA, of which I will hand over to Claire to tell us a bit more about.
Thanks, Katy. So having heard from Katy on what ESG is and why it's important to banks, I'd like to tell you about how ESG concerns interact with loan documentation. Whether or not you're directly involved in drawing up loan documentation, what I'm going to share should hopefully be useful to you. It certainly should be if you're involved in negotiating the heads of terms in lending transactions, or if you're responsible for reviewing template loan documentation and keeping that up to date, or indeed if part of your role is to instruct external lawyers like us to help structure and document transactions. So moving on to the next slide, many of you will be aware of the Loan Market Association, known usually as the LMA. For those who aren't, the LMA is a London-based organisation which was originally set up in the 90s in order to help facilitate the development of the secondary loan market in Europe. The LMA is now active in both the primary and the secondary markets, and it aims to guide best practice in the loan markets by issuing guidance and template standard documentation. They have a really useful website, so do check it out if you're not already familiar with it. If your organisation is a member, which I assume will be the case for most of the attendees of this session, you'll have access to really useful short training courses, as well as podcasts and other materials, including some with an ESG focus. On their website, they have a dedicated sustainable lending microsite, which is really useful for keeping up to date on what is new in the area. For example, there you can find the various sets of sustainability loan principles which the LMA has recently released. The longest standing set of principles are the Green Loan Principles, which were launched in 2018. But we now also have the Social Loan Principles and the Sustainability-Linked Loan Principles. These were formulated in collaboration with other international loan market association bodies. The Green Loan Principles focus on use of proceeds, process for project evaluation and selection, proceeds of green loans, and reporting. The Sustainability-Linked Loan Principles focus on identifying the existence of the borrower's overall sustainability strategy, performance target setting, and reporting. Both of these principles specifically tackle the issues of greenwashing and sustainability washing. The Sustainability-Linked Loan Principles note that sustainability washing can occur in two main ways. Firstly, that sustainable performance targets are set, but aren't sufficiently ambitious or meaningful. And secondly, that there is inaccurate monitoring, measuring, and disclosing of a borrower's performance against these targets. Hannah will look at this more closely in the next session of the seminar, which will deal with the challenges for banks in the ESG space. So moving on here to the next slide. When it comes to actually documenting green loans or sustainability linked loans, there are currently no market standard terms or templates to follow. However, there are some ESG related terms and mechanics which are proving popular to include. For borrowers, one of the key impacts of an increased focus on ESG in the loan market is that they're more and more likely to find that the cost of finance is tied to sustainability metrics. The way that this is usually done is by a margin ratchet, which gives the borrower a pricing incentive to comply with certain ESG-related targets, which are included in the loan agreement. As well as this positive incentive, the margin ratchet can be drafted so it goes both ways, so that the borrower's failure to comply with set targets leads to a margin increase. In some loan documents, we have seen provisions being added which include a requirement for any pricing change amounts to be applied in a specific way. For example, the borrower could agree to donate any margin savings to a certain charity or to apply them towards meeting relevant ESG goals. Although so far it seems to be less common, there is also the possibility for the lender to agree to pay the amount of increased margin to charity or some other ESG related application. Lenders may wish to consider this option more if they view it as a reputational risk that they might be seen as profiting from borrower ESG target failures. When setting margin ratchets, targets and key performance indicators, it's important to make sure that these are bespoke and match the business of the borrower company. As well as including appropriate and measurable KPIs, there needs to be a workable timeline and workable reporting requirements. The KPIs will be different for different types of businesses. The most obvious one for heavy carbon emitters would be a measurable target for emissions reduction. And other green targets could be things such as measurable reductions in energy consumption or targets in respect of maintaining or improving water quality. For sustainability-linked loans, the targets do not necessarily need to be environmental. These may include targets crafted in order to promote an improved gender balance in senior management or to ensure payment of the living wage to all employees, which is set at a level above the statutory minimum wage. It's also possible that no specific targets are referred to, but the margin will instead be determined based on a sustainability score provided by an agreed external provider. There's a growing industry of sustainability performance target advisors, and one route which has been taken is that these advisors verify target performance, which is then included in audited financial statements. This eases the monitoring burden on lenders and the reporting requirement on borrowers, and can be an efficient way of doing things, though of course there is the additional cost to the borrower. So if we move on to the next slide, we'll see that so far we're not seeing failure to meet sustainability performance targets as resulting in events of default or indeed any draw stop scenario. If a two-way margin ratchet is used, this is the only stick we're seeing as being used against a borrower who doesn't comply with their targets. And of course, that margin target isn't necessarily always used. The fact that the importance of these targets are not being backed up by failure to meet them resulting in events of default does perhaps diminish from their potential to be really effective, and in some instances might open up accusations of greenwashing or sustainability washing. On the other hand though, borrowers might be wary about agreeing more ambitious targets if they know failure to meet them is linked to an event of default, so it's quite difficult to measure the impact. As well as margin ratchets and sustainability KPIs and targets, ESG representations and undertakings are increasingly likely to be used. An example of an ESG representation could be one related to current water quality ratings. An example of an undertaking could be one to use energy from only renewable energy sources, but these are only examples and there's a massive range of possibilities. A final point to note on the documentation side of things is that increasingly a sustainability coordinator is being appointed within the loan documentation. This is relevant in a syndicated transaction where there's a number of lenders. The sustainability coordinator is nominated in the same way that a lender can be nominated as security agent or account bank, and this lender takes on increased responsibility for leading target setting negotiations with the borrower and for other related tasks. So now that we've looked at how ESG issues are currently being incorporated in loan documentation in the market, I'll pass over to my colleague Hannah, who will be explaining some of the challenges to banks in the ESG space.
Having talked generally about the principles behind ESG and its importance to banks as outlined by Katy, and how loan documentation will drive the change envisaged by these ESG principles as outlined by Claire, I'll focus for the next 10 minutes or so on the challenges that banks will face in their efforts to adhere to these ESG principles. The main challenge for banks is a general lack of consistency within the ESG space, and in particular in relation to standard reporting methodology, eligibility criteria, and the avoidance of sustainability washing. So this slide there just summarises what I've just spoken about there. If we follow on to the next slide, and we'll deal first with the lack of consistency in the standard reporting methodology. As yet, there's no globally accepted methodology for reporting on SPTs. If there's no clear framework for the methodology and reporting, then it becomes difficult for banks to obtain a level of verification or standard of third-party review of those borrower reports, which they're comfortable relying upon. In addition, there does not appear to be a general acceptance within the market as to who should bear the brunt of this, i.e., who's the party that shall pay for the verification of the reports. It is possible that if borrowers see the tangible pricing benefits from their loans being sustainable, then they will be happier to bear this cost. This lack of consistency in standard reporting methodology can be traced back to the fact that over the past few years, various standards and benchmarks for ESG reporting for businesses have emerged on a somewhat fragmented basis and in a variety of guises, including various national and supranational guidelines and frameworks, of which the vast majority are voluntary, all of which has led to slightly different requirements for businesses, which has led to calls for a global ESG reporting standard. Until recently, mandatory reporting remained fairly localized, sporadic, and issue-focused. Excuse me. In July this year, however, the G7 finance ministers announced a commitment to mandate climate reporting in line with recommendations of the Task Force on Climate-Related Financial Disclosures, TCFD. The UK is now a little ahead of its G7 counterparts, as at the end of last month, the UK government announced that TCFD reporting would become mandatory for large businesses and financial institutions from April 2022. The EU, however, has probably been the trailblazer in this sphere, and at least in relating to the reporting standards within the climate environmental sphere, with the Corporate Sustainability Reporting Directive, which requires corporates to disclose information against the taxonomy framework, which I'll speak more later on. Whilst the EU has been trying to push its taxonomy as a global framework, and the work of the IFRS and its announcement earlier this year to establish a global sustainability reporting standard could be seen as steps towards a global level playing field, the very fact that you have a myriad of national and international guidelines and frameworks, albeit moving towards mandatory requirements, does little to elevate a bank's concerns of the benchmark to which you should be testing supporting standards and loan documentation. It's therefore a challenge that is set to change incrementally. The important point for banks, for yourselves, to take away from this is that whilst you must be perhaps alert to the issue and the challenges it can produce, it may also be wise to view this lack of consistency or standardised framework as an opportunity to work with the guidelines rolled out by such bodies as the LMA in such a way that the banks themselves become the key drivers as to what over time may become generally accepted standards in reporting and reporting methodology in the loan market. So if we move on to the next slide, here I'll be focusing on the inconsistency in relation to the products available and the eligibility criteria. In terms of product offerings, many banks are now offering specific sustainable products or linked products, including loans, mortgages, and bonds. As we know, the term sustainable in the loan market can refer to the loan being sustainability linked or for sustainability purposes. The categorization and therefore the eligibility criteria of the former is perhaps more of an issue for banks than it is in relation to the latter. As Claire's mentioned, the loan market trade bodies produced a set of sustainability-linked loan principles. This set of principles is not, however, legally binding, but it is hoped that it will help to develop some consistency across the market. The lack of teeth of these principles, however, whilst they produce flexibility to banks, may mean that reaching a generally accepted standard on eligibility, that's to say, how would a bank determine whether the asset or the development being financed is environmentally friendly, for example, and thereby know what products can be offered or are most suitable, can be problematic. That being said, in tandem with the loan market strides in this, there is also legislation and regulation that's been rapidly evolving. Last month, and just in time for COP26, the government released its policy report, which is essentially a roadmap to encourage UK businesses, investors and banks to have regard to ESG considerations in their decision-making processes. The roadmap, amongst other things, reveals the progress in relation to the development of a UK green taxonomy. So if we move on to the next slide and we'll look more closely at this. If we move on, thank you. The taxonomy will be a set of criteria that can be used as a common reference point to ascertain whether an economic activity may count as sustainable in the UK. The taxonomy includes 6 environmental objectives, all identical to those found in the EU taxonomy. These are climate change mitigation, climate change adaptation, sustainable use and protection of water and marine resources, transition to a circular economy, which basically means maintaining the value of products, materials and resources for as long as possible, and by doing so reduces the environmental impacts of their use. Pollution prevention and control, and protection and restoration of biodiversity and ecosystems. All these environmental objectives will be underpinned by a set of detailed standards known as the technical screening criteria, the TSC. The TSC for objectives 1 and 2 will be subject to consultation in Q1 2022 ahead of the government's plan to table legislation in 2022 in relation to those. And then the remaining 4 TSCs will be scheduled for consultation for Q1 2023. Moving on to the next slide. In order for an activity to be considered taxonomy aligned and therefore truly sustainable, the activity must meet 3 tests, which are similar in substance again to those required under the EU taxonomy. They must make a substantial contribution to at least one of the 6 environmental objectives, which we listed in the previous slide. They must do no significant harm to the other environmental objectives, and they must meet a set of minimum safeguards, including alignment with the Organisation for Economic Cooperation and Development, all of which will impose really quite heavy technical screening burdens on eligibility criteria. However, the hope here would be that the development of the UK taxonomy provides a clarity that is needed so that when coupled with the development of standards and principles offered by the market itself, there will soon be a greater consistency with regard to eligibility criteria, which will then pass down to the products that banks can make available to its borrowers. Finally, moving on to the next slide, the last slide topic I'll be speaking of, which is the avoidance of greenwashing. As we know, ESG has become, or is at least becoming, mainstream. With this, there's been inevitable, and indeed is one of the very reasons for giving this presentation, a rise in volume in greener, sustainable claims made by companies' borrowers in their attempt to demonstrate their sustainability credentials. However, this volume, when coupled with the lack of consistency or non-uniformity to eligibility criteria and reporting, has made it very difficult for banks to identify when claims are trustworthy and when they're not, i.e. when there may be greenwashing or sustainability washing. The term greenwashing was first coined by an environmentalist called J. Westervelt almost 40 years ago, where he claimed a hotel was encouraging its guests to reuse towels to help protect the environment, when in reality the ask was a marketing ploy to help the hotel cut costs and improve its profit margins. Over time, however, the definition of greenwashing has morphed. While in J. Westervelt's example, environmental benefits were still ultimately achieved, despite the primary motivation being cost-cutting, concerns about greenwashing have become broader in scope, with companies perceived to be making exaggerated or misleading environmental claims, sometimes without offering significant environmental benefits in return. The structure of the sustainability-linked instruments, which allows the use of proceeds for general corporate purposes, has increased fears that proceeds may directly fund projects without a clear beneficial impact, making them a new platform for green sustainable or social washing. Social washing seems to be of a particular challenge, as being able to quantify the impact in such financing is harder. Social impact is almost by definition more difficult to quantify and relies more on qualitative measurements, which means any measurement may be less objective and generally introduces greater inconsistency across the market. As mentioned previously, there's a lack of reliable and comparable ESG metrics and reporting, which only adds to fears from banks to the threat of claims of greenwashing or sustainability washing. In the absence of a common standard and enforcement mechanism for instrument-level ESG disclosure, the quality and the consistency of post-issuance use of proceeds and impact reporting is still highly fragmented, making it difficult to compare and aggregate performance. So how can banks act to ensure that sustainability and greenwashing is avoided? I've set out on the slide some key considerations for banks to take into account when considering structuring a sustainability linked loan, such that it may avoid such accusations. One of the key performance indicators should be specific to the ESG concerns of the business the development or the asset which is being financed. This may sound pretty basic, but banks should be considering that the KPI bears a sufficient relationship to the ESG linkage of the financing. To this end, banks should expect to see that the KPIs are in line with a corporate's overall ESG policy strategy and undertake a review of that to ensure that there is alignment there. Key performance indicators should be sincere and meaningful. If there's a performance indicator which a corporate would be expected to do, to be doing in its ordinary course of its business in any event, or which is of questionable ESG benefit, i.e. it wouldn't align with the taxonomy issued by UK government referred to earlier, then that should be avoided. There's no real value, for example, of a corporate providing a covenant to its lender that it will ensure that all environmental laws subject to real estate, which is the subject of a financing, will be adhered to, when this would be a generally expected covenant to be given in the market in any event. The key performance indicators should be ambitious. The requirement for ambitious targets is expressly included in the LMA SLL principles. So this is really a baseline requirement for SLLs. However, even where the SLL KPIs selected are the right ones for the business, there may be criticism if the KPI targets are not set at a level that is seen by observers as sufficiently impactful. So it's not enough for a borrower and its bank to simply agree to continue along an existing achievement trajectory in relation to a particular SLL KPI. Market observers will expect that KPI targets are a stretch and which require positive steps to be met. Then Claire is going to round things up for us all.
Thank you, Hannah. So I think if there's a conclusion that we can draw upon at the end of this discussion, it's that whilst the reasons banks need to be concentrating on ESG issues are clear, the systems and frameworks which would aid banks to operate in this area are not. This, however, could be used as an opportunity for banks. They're already ahead of most governments in realising that there are more benefits to sustainable finance than solely the end project or end result. They're realising that this kind of finance reduces risk for the market overall, and so they also have the chance to lead the way in setting the standards, framework and guidelines for reporting and eligibility criteria, and for ensuring trust in the system. Thank you all for joining us today. Please do feel free to get in touch with any of us directly if you'd like to discuss anything that we covered in more detail. And for now, it looks like we've got one question submitted here, which is, do you think that green finance is going to be the main type of finance in the next decade? So I think I can just answer that one. And what I'd say is there's a lot of talk about green finance at the moment, but I think what really needs to happen is a sort of shift whereby we're no longer talking about green finance as a specific sector, but indeed that the whole of finance is green. You know, we have a mindset that we're thinking about green things and ESG things whenever we're taking on any piece of finance. And that makes sense from both environmental and ethical perspectives, but also, you know, the bottom line risk perspective, which is important for growing the businesses of the banks. And of course, in the next decade or so, there's going to be a lot of finance for specific green projects. But I do think in that broader way, it is the sort of broader ambition to get the finance sector on board with these green opportunities. And yeah, just help us all get towards net zero that bit quicker. So I think it's an exciting time to be in the sector, to be part of that shift, and hopefully we'll work with a lot of you in getting towards that. So thanks again for joining us. We hope to see you at our next Banking Academy session, and do feel free to get in touch with any of us if you have any further questions. Thank you very much.